The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity. Prepare for your retirement. Safeguard your savings. And nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings, investments, and your retirement here on the Max Out Savings Show, one of Houston's longest-running financial radio shows. We've been on for, it's coming up on 20 years almost, talking about savings, talking about investments, talking about the world today, helping you deal with retirement. We have a lot to talk about on the show today. Actually, a number of huge events happened this week. We're going to be going over them on the show. We're talking about some savings ideas. Remember, our motto and our philosophy is to save aggressively and invest conservatively. That's what we call it the Max Out Savings Show. And we want to encourage people to save money. In many parts of the world, particularly Asia, people save 2 and 3 times the percentage of Americans. And in a world today where we have high inflation, record high budget deficits, out of control federal spending. We're struggling to get them under control. You want to have a backup plan, a savings plan. You want to have a savings for retirement. And so the best way to do that is to aggressively save money and then conservatively invest it. Hence, save aggressively and invest conservatively. It always starts with your company plan, that your qualified plan that you have. You put away 10% minimum plus the company match that typically gets you up to about 13%, some cases 14, 15%. That's what the numbers say you need to save for retirement. After that, you can spend as much money as you want out of your paycheck. It doesn't make any difference. And in long term, you build up wealth. This is how you build up wealth. The 401k, 403b, these are the most successful wealth building programs the world's ever seen. And keep in mind, not only are you putting away money, you're getting a free tax deduction, then you're getting free tax-free growth during that time frame. Something we've talked about. Warren Buffett, we've studied Warren Buffett, he's famed value investor, probably the most successful investor in the world. One thing that most people don't realize about Warren Buffett is he was an absolute master at avoiding paying taxes. He bought an insurance company because he could get tax-free growth inside the insurance company. If he buys a company and he wants to sell it, or he takes a big position in a company, and someone wants to buy it, he wants to own the stock in the new company so he doesn't pay any taxes. Well, the government gives you that for free. For all the work Warren Buffett did, the government gives you that for free in a IRA 401k program. These programs, because you get tax-free growth. So something to think about. That's where you start. That's where you build up the wealth. It's called income-based savings, which you save a percentage of your income, and then you build up wealth. Now, as we said, we got a lot to talk about on the show today. Looking out, we basically it was kind of very much of a watershed week, and I want to go over a couple big things that happened this week, and how they're affecting the markets, and where do we go from here? We had the Fed meeting, number one. We had Donald Trump adding new tariffs, number two. We had some job numbers, which shockingly there was a huge revision in jobs numbers that came out. Number four, President Trump talked on the drug companies, and he said he wants them to reduce their prices, and the Americans are paying too much for drugs. So we're going to hit those things and talk about them. This week, the S&P 500, the markets hit a record high in Thursday, and then by the end of the day, it had reversed down about 600 points off the top, and then the market fell apart again, down over 500 points on Friday. What's going on there? We're going to discuss all these things here on the show today, and where do we go from here? And cover a number of other things on the show as well. The first thing we really want to take a look at is the Fed meeting. there's been a real dispute between Fed Chairman Powell and President Trump. President Trump says interest rates need to go lower. He wants the economy to do better, but more importantly, keep in mind we have $37 trillion worth of debt. Now, the Federal Reserve, for the most part, controls short-term rates. They can do a little bit of what's called yield curve control to push down longer-term rates. That's much harder, but they control the short-term rates. We're borrowing as a percentage of our borrowing a larger number than most developed countries short-term now. This was started by Biden administration under Senator Secretary Janet Yellen. Because what they wanted, they kept short-term rates down, and so they could keep the deficit down and not have to borrow money at these high rates on the long term. So what President Trump is trying to do is he's like, look, I'd like to get these rates down because I want to control the deficit. Keep in mind we have a $2 trillion deficit from Joe Biden that we're trying to reduce now. Well, we have $1 trillion worth of interest expense, and if we can knock a couple $100 billion off of that, that goes a long way to reducing our budget deficits. So the Fed meeting came out, no change is expected, although there were two dissents, and this is we rarely see dissents. So 2 of the 4 of the governors said, look, things are slower and we really should cut rates. They didn't like the jobs numbers. But during the most typically they have a press conference afterwards, and the Powell made it clear that he wasn't going to be pressured by Donald Trump to cut rates, and the market started reversing off of that, and it went down. But then the interesting thing happened the next day. So Chairman Powell says, look, we're not cutting rates unless something happens. We're being tough, and we're going to set Fed independence, and that's important. Well, the next day there was the jobs numbers come out. They were expecting, I forgot the number, 140,000 jobs, I believe, somewhere in there. It came in at 73,000 jobs. Not good at all. The economy's not producing up. But more importantly, there was a 258,000 downward revision over the last couple of months before that. So a massive loss of jobs and across the board. That triggered a plunge in the markets and a drop in interest rates pretty much across the board. It indicated that the economy was slowing materially more than people had thought. It was actually such a big miss that President Trump fired his labor commissioner of labor statistics. He said that she was a Biden appointee and she was kind of rigging the thing. And there is some pretty good evidence that before the election, she's triggered some revisions then that caused the Fed to cut rates 50 basis points right ahead of the election, and then after that, they didn't make any revisions to help out the jobs numbers. But that's aside. So here we are. The markets have reversed down, substantially sold off, across the board. But I think it's important. We want to see what happened when that came out. What happened when people thought that the Fed might cut, the economy's weaker, the Fed might cut rates, and that's where it gets kind of interesting. Gold, well, a couple things. The dollar fell about 1.27%. That's a huge drop for the dollar. I mean, this is against a basket of currencies. 1.25% drop in the value of the dollar is a big deal. And some people go, uh-oh, what's going on? The Fed's going to start flooding the system with money again. They're going to print money, and rates are coming down. I don't want to hold dollars. These guys are borrowing too much money. They have $1 trillion borrowing every 100 days. That's kind of gone away, but there's still big issues. The dollar plunges. Gold goes up $74 in one day. So again, oil fell 3% because the economy is weakening. The dollar is weakening, and with as well. And so people are thinking the economy is slowing. The government's going to get in trouble. I want to own gold. And how are these companies going to make earnings? And this is what we saw, a big sell-off across the board in the markets. So what this is telling us is if this economy weakens, the world is frightened, the Fed's going to cut rates, flood the system with money, and the dollar's going to go lower, gold's going to go up. That was pretty much the message that came across on the thing. And then, of course, earnings are going to go down. And so a couple questions come in. Look, I don't think this is over as far as that goes, and we're going to discuss that with discuss the markets a little bit later on. But again, what we're dealing with is a very unstable situation in the economy to some extent. Now, a couple thoughts we want to touch base on. Why are the jobs low? A couple things. I think there's a lot of people that are quitting their job. Immigrants are either quitting their jobs or staying home because they don't want to get deported out of the country. Illegal immigrants, excuse me. And so I think that is really pushing pressure on these jobs numbers. And I think that's one thing that we're going to be seeing. I think it's a bigger deal than people realize. If you see it in some of the numbers, for instance, Modelo beer is down. I think it was like 7%. This is people not wanting to go out to bars because the immigration is going to raid the bars, or whatever, and so it's leading to a slowdown in the economy, and we're in this massive. Basically restructuring of the United States of America. President Trump came into power. We're borrowing $1 trillion, additional $1 trillion every 100 days. He gets in office. This is what we got, sir. Mr. President, you've got to fund $37 trillion worth of debt. There's a debt freeze out, and so we're not borrowing any. We haven't borrowed any money since January 21st. We're going to continue. Now they're starting to borrow because the debt limit has been lifted. So he has to deal with this issue. He has to deal with out of control trade deficits, where people are U.S. companies are moving their factories overseas to save money, to boost their margins, firing U.S. workers. This is hurting the U.S. economy. More importantly than that is critical products in need of war or pandemics are being produced overseas, which means the minute the war or the pandemic starts, we lose access to them, and it endangers the United States of America. And this everything from rare earth minerals to magnets to antibiotics to the precursors for many drugs. And so he's got to go and restructure that. So he's putting these tariffs in place to do that. So we're putting tariffs in. We're being flooded by 15 million illegal aliens under the Biden administration that poured into the country with effectively open borders. Many of them were terrorists, murderers, rapists, and everything else. And many of these people, they knew they were, and they just didn't care. They just let them in the country. And so he's got to clean that up. Crime is spiraling out of control because of the illegal immigrants. So But this is that means he has to do a couple things. He's got to cut spending. He has to sit there, put tariffs in place to force the factories back to the United States, tariffs in place to create taxable income to reduce our budget deficits, and stabilize the country. And he's got to get the illegal immigrants out, particularly the lawless, huge numbers of lawless immigrants out of the country, to stabilize the country in the crime. And so this is an effective restructuring of the country. He has, I use the number on the show, $500 billion worth of factories coming back. He claims it's like $2 trillion or something. I think $500 billion, which is a massive number of factories coming back to the U.S. So those are coming back. That's all good news. These factories take time. These things take time to come in place. So we have a lot of uncertainty, a lot of back and forth. We have immigrants leaving the country. We have immigrants losing their jobs or quitting. We just have a lot of uncertainty right now. But start next year, these new factories are coming in. These new operations, the people that's going to be hiring for those, the money's going to be coming in from the tariffs, the interest rates are going to be down, the budget deficit is going to be down, and things are going to improve. But right now, there's a lot of uncertainty, and this is what we're going to discuss on where that's going to go next, right after this quick break right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com. In the 1970s, the big song was the Bee Gees' Stayed Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
Hey everybody, Charlie Kirk here. Ted Gioka, the founder of Max Out Savings Advisors, always says, save aggressively and invest conservatively. He specializes in helping people grow their retirement account with as little risks as possible. Ted combines working knowledge with the intuition gained from over 25 years of experience of value investing in the stock and bond markets for retirement accounts. Like you, Ted is deeply conservative in life and in his investment approach. His risk strategy allows him to anticipate market downswings to protect your money. Ted is also the conservative host of the Max Out Savings Show. You can listen to him every Saturday morning at 10 a.m. right here on The Answer. If the idea of saving aggressively and investing conservatively appeals to you, the best way to get to know Ted is to call him. The number is 713-627-0400 or visit maxoutsavings.com. That is maxoutsavings.com. Call Ted right now, 713-627-0400, or visit maxoutsavings.com.
Once again, here's your host for the Max Out Savings Show, Ted Gioka.
Morning. Welcome back to the Max Out Savings Show. I say morning. Actually, we have a repeat on Sundays, I believe at 4 p.m. Anyway, so we're talking about what's happening in the world today. What's happening with the markets? We had the Fed meeting, and then we had the huge loss of job numbers, and that resulted in a substantial. Once that came out, people saw the job numbers weren't as good. That we had a 258,000 revision, which means over the last 2 months before July, which means we produced very few jobs during that time frame. There's a lot of mixing in the economy now. Immigrants are leaving the job market. Illegal immigrants are leaving the market. Government officials are leaving the job market because they're being laid off, and so we're seeing a lot of that stuff. When the market saw that, the stock market fell. The S&P 500 fell. It's down about 2% and 2.3%. The Nasdaq down 2.7%. But interest rates fell as well. The 10-year went from 4.4% to 4.2%. The 2-year, which we've talked about, we said, look, when you can get the rates 4% or above, you want to own the 2-year. Well, the 2-year went from 3.7 on Thursday down to 3.51, which is a drop. And so you're seeing interest rates drop. They're anticipating. And one thing to remember, there's a theory out there that says the Fed basically follows the 2-year, and the 2-year is really starting to plunge now. And so look for possible rate cuts coming up. The question is how intransient is Chairman Powell going to be? But and gold is going up, dollars falling. So all of these things are working in. So these are big changes that are happening very quickly. Now, the markets. We had some positive things this week. We had Microsoft, Meta, Apple reported good earnings. Apple actually reversed down afterwards. Meta was up. Microsoft was up. Look, I think the tech sector I think it's vulnerable here. I really do. Yeah, I looked at some of the numbers on Meta, and Meta basically they're projecting the earnings for 24 were about $24 a share. They're going up to 27. Maybe they hit 28. I haven't seen. They're going to be bumping up the numbers on Meta. So good earnings growth out of Meta, but it's kind of suspicious because if you look at the capex, which is the spending, it goes from about $37 billion in 2024 up to 66 to 72 billion, almost a double in cap. And this is massive. You're talking 30 something billion dollars worth of additional capital spending, and yet the earnings are going up. And you're like, well, how is this happening? They're not making that much more money. And the answer appears to be they're stretching out their depreciation schedule. So it's about 10 to 12 years. Well, the problem with that is if you look at all these AI chips they're buying, those things have 3 to 4 year life on those on the chips. So how are they pouring tens of billions of dollars into AI and then depreciating out their stuff? And I think they're getting into electricity. Production things. I think what they're possibly doing is I think they're actually I think they're being way too aggressive on their depreciation schedule. And to remind people, the depreciation schedule is if I'm spending $60 billion this year in or let's say $70 billion is about the average at Meta, well, I got to deduct that off my taxes. But if it's depreciated this year, like many small businesses, there's some in the Bill and Beautiful Bill, there you can deduct 100% of capital expenditures. So a lot of small businesses go, oh wow, this is great, I don't have to pay taxes. Well, what these guys are doing is they're depreciating this stuff because typically if you buy a piece of equipment, let's say it's a tractor, the tractor's got a 20-year life, and maybe you depreciate it over 10 or 12 years or more of the depreciation life on the piece of equipment. So if it's 10-year depreciation, so if Meta is depreciating this, and bear with me on this, it's a little complicated, $70 billion worth of capex, and they're doing it on a 10-year average, that's just $7 billion a year off the top, so their earnings continue to look good. I think they're being overly aggressive on their, in way too optimistic earnings-wise on their depreciation schedule, and I think this is artificially bumping up their profits. And what happens is eventually if they see it, if it doesn't work, they do a big write-off. Well, it doesn't make any difference. They've had 2 or 3 years of phenomenal growth, and they push the price of their stock up. This is why one of the big mysteries has been, well, how are they doing this massive capex in tech, and their earnings keep accelerating? They're linked into depreciation. They're being overly aggressive. I think within the next 6 months, you're going to start hearing a lot more about this story, and there's going to be pressure on the tech sector overall. Many of the tech stocks have broken to new highs, but they almost look like false breakouts. I would, at the minimum, take money off the table in the tech sector. I think there's a real possibility that this sector is topping in here now. Something to see on that. So anyway, we talked about the two of the big four that happened this week was the Fed meeting, and which is no change, but there was dissension in the meeting, 2 votes against it. And then the jobs number, which shockingly there was only expecting about 140,000 jobs. They came in at 73,000 jobs, but even worse, they downgraded over 250,000 jobs over the last 2 months before that, so they weren't there. And so the next thing that President Trump came, he added more tariffs on. So the tariffs are with some countries, they're extending some of the negotiations on the tariffs, but listening to some of the conference calls this week, and some of them were not that pretty, particularly in some of the manufacturing areas, in the fact that what appears to be happening is there's enormous amounts of movement around the world of commodities. And so if China is making, say, a chemical, they were importing in the United States, what they're doing now is they're moving it to Vietnam or some other country that Mexico or somewhere where they can claim it was made there, and then they ship it into the United States at a lower tariff rate. And there seems to be there seems to have been a lot of stockpiling earlier in the year with the anticipation of this happening, and then we're seeing a drop off there. So it's just like with the immigrants issue in the jobs. There's a tremendous amount of churning underneath the economy in all these areas. And I think I listened to some calls where they really said the tariffs were having a big impact, affecting the buy Ford. Apple claimed that only 1% of their purchasers were people buying Ford, and a number of analysts expressed real skepticism with that number. And so the question is, later this year, do we see a sell-off there? But you are going to see some inflation, and you're going to see some disruptions on the tariffs. And I think we're starting to come into that area. And so this is the other thing to watch. Now, the other big development, and again, a lot of things happening this week, really I think big changes. And another one was the drug prices. In the United States today, if you go to Europe, if you purchase a drug, it might cost like $100. But if you purchase the same drug in the United States of America, it's like $500 to $1,000, because we have to support the drug companies. It's so expensive to sit there and produce drugs and introduce them into the market. It's so expensive we have to have high prices. You're like, well, wait a minute. Why do the Europeans not have to have? Why do we have to fund all the research? And they get the advantages. And so Trump says, look, I'm going to give you guys till September 29th to cut these drug prices. They're too high. And if you look what's happening, they should be the same price as what Europe and Asia is paying for their drugs over there. Now, the drug companies aren't going to sit there and cut all their prices to European levels. They're going to negotiate. They're going to say they're going to bring back some factories. But they are going to have to cut prices. Trump's going to do some things as well. They're one of the things they're working on with some of the drug companies is they're looking at these drugs like Wegovy, the weight loss drugs, which now are only approved for diabetes. And they're saying, well, look, why don't we do a test and see how it does if we give them to a group of people at a cheap, we insure them and see how their health does. And so the drug companies are likely to go, well, look, if you give it to everybody, we'll cut the price way down, and you'll save money because these people's health will be that much better. You're going to see more deals like that. But this is going to put pressure under the drug companies. They're going, President Trump, we have inflation in the United States. The American people have been suffering through this. It's very tight. If you look at spending at restaurants, if you look at other things, it's starting to drop. They're under pressure. And Trump, the United States is under pressure. We're borrowing, as we said, we have $2 trillion deficits they're trying to get under control. We can't afford to be bankrolling drug companies and other companies with sky-high margins out there. And so this is a big story. Again, are the drug companies going to cut prices to what they're paying in Europe? No, but they might raise some of the prices in Europe. They might cut some here. They're going to move some factories back. They're going to make some deals, and it's going to reduce the cost of health care. One of the most amazing things about the United States is how we shifted from being a democracy over to a kind of a country run by an elite group of people that manages things, and then they're bought off by lobbyists. And we have these. If you look at basically the three or four biggest items for inflation, if you look back 20 years to today, 25 years, the things that have gone up the most have been drug costs, have been medical costs, have been college costs. All of those the government is right in the middle of, and it's been a complete gravy train. So again, this is restructuring. This is going to affect the drug industry. Now, if Trump gets his way, a couple good things are going to happen: lower drug prices and more plants and equipment coming back and more jobs. So again, but this is not a positive for the drug companies at all. And so here we have the drug companies under pressure. We have the auto companies under pressure for paying more for tariffs to get your jobs back. We have other manufacturing the tech companies are going to come under pressure one way or another, and you can't have everyone else suffering in the tech companies, printing money all over the place, collecting your data. But so these are not all lower job numbers. A Fed meeting where there's dispute between the president and the Fed chairman, adding tariffs, where some people aren't agreeing with us, pressuring the drug company. These are not positives for the stock market. Make no mistake about it. Now, the positive might be that rates are coming down, but understand the stock market's been going up most of the year on the belief that the interest rates were coming down. They're already priced in, but now we got the negative side of interest rates coming down, which is, hey, if interest rates are coming down, that means the economy isn't doing as well as expected. So what I think we're really starting to look at here is is the situation where the market has gone up on basically hope and belief, and there's really been somewhat of a mania. We had that one, was it FIG? I think FIG, Figure or something, came out. The stock, I believe, came out at $40. It was 5 times oversubscribed. It opened at $80, and now it's at $115. They have some software that works real well with AI in different design things. But that's bubble material. That's when you see things just rocketing up like that. You see these meme stocks tripling or doubling in one day. The heavily shorted stocks are skyrocketing. You see these big. I think Apple and I think Microsoft and Facebook went up. Had good news on earnings. They went up. The total value those two stocks went up. Exceeded the amount of value they created in addition with the good earnings exceeded the market capitalization of the European stock market. And this is more euphoria in the stock market, and that euphoria door might have just closed on Thursday with the press conference with Chairman Powell, and then the jobs numbers on Friday. And I think that's going to be the real thing. And again, what came out of that is that if people think rates are coming down, if they think the economy's slowing, jobs are going, they think rates are coming down, they think the Fed's going to print money, they think gold and silver are going to go up, and that kind of fear trade is still out there, and so that's kind of what we're looking at. And the other thing, let's see, how are we doing time? Okay. The other thing that's happening is Trump is still negotiating with Putin to try to do something in the Ukraine. He's given him to 10 days, and then basically the Russians threatened him. Dmitry, what's his name? The former president threatened the United States directly, and Trump moved over 2 nuclear missile subs into the air. That's not a positive, and I mean, this is really hardball negotiations with the potential for. I mean, if Putin keeps going in there, and I think it's going to be more and more likely that NATO moves troops into the Ukraine, and that's going to lead to some type of standoff, and because that's the most likely thing. I mean, they can give Ukraine more weapons, but candidly, they're running out of people. They just it's. I think there's a real danger that thing spikes up, and so this is the other thing we're going to watch. So again, this week, big changes across the board. We've had a market that's been euphoric. Really, some of the numbers have come in have been closer to 1999. You have stocks just skyrocketing up on no earnings or just the belief of something. Huge market capital additions with earnings. And again, we talked about Meta. Meta, if you look at Meta somehow doubled their capital spending. Made their numbers, but then they increased the depreciation link. Their depreciation link, although the area they're investing the most in are short-term AI products. Short-term is in 3 or 4 years. So a lot of stuff happening. We're going to discuss some more about this and how this affects your retirement after we get back from this quick break right here on the Max Out Savings Show.
If you've got savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday at 7 a.m. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show. We're talking savings and investment in your retirement. I want to mention one of our sponsors, Rangoni Alto Gin. It's a pure botanical gin from the high in the Italian Alps, all organic. They have some of the finest botanicals in the world, and they're put together with recipes that go back hundreds and hundreds of years. It's a phenomenal drink. If you get a chance, try it out. It's Rangoni Alto Gin. Look for the kingfisher bird on the label. You can get it at Specs or Total Wine. Now, a couple of things. If you have any questions or comments, you can give us a call, 713-339-1070. We had a question about copper. This is an interesting situation. Copper, a couple days ago, was trading about $5.70. And then President Trump lifted some of the tariffs on it, and it plunged down to $4.20, which is a huge collapse in the price of copper prices. So what happened there? Trump said they were going to put tariffs on the price of copper. And so what happened is he did this a month or so back. There was massive amounts of copper moving into the United States, and there was rumors he was going to do it for a while, and so people they rushed to get the copper into the company ahead of time, and then figured when they put the things on, the copper would go up in value. So much copper came into the United States that the warehouses in New Orleans, which is where most of the copper seems to go, filled up, and they started moving them over into some of the ports in Florida. Now, this was good because it really boosted the price of copper. But then what happened was the tariffs came out, and he exempted something in particular, the copper cathodes, which is copper using cathodes, and people had not expected that. So a lot of commodities traders had bought copper, were selling it, and then once this came up, they were stockpiling it. All of a sudden, there was not a 50% tariff on the copper cathode, and the price plunged. And that's what we saw there. And that actually happened Wednesday. And so huge drop. I mean, copper basically fell from about $5.60 down to $4.42. It's $1.20, which is a massive, massive drop in copper. But again, big drop in copper. If you look at the 10-year plunged yesterday, the 10-year bond from 4.4 to 4.22, a big drop. Again, we're seeing a lot of movement all of a sudden in different markets around the world. I think at the present time, you want to be cautious in here. I think you really have to have your guard up, as we talked about. We've been telling you for months now. Look at the 2-year Treasuries, an opportunity of 4%. The 1 year over 4%. Look at money market. Spread your risk into precious metals. Come on, other things out there. By the way, we still like copper. We're holding our copper. Copper is going to do well. Just to get back to copper for a second, copper is in huge demand for electricity generation, for electric cars, for AI. The biggest trends out there in the world today, copper is right dead center in the middle of them. This had more to do with a tariff arbitrage that blew up with some commodity traders. But so spreading your risk across the different asset classes, foreign stocks, U.S. stocks. I've been saying this. I still think of is the standard 60-40 split, where 60% S&P 500 and 40% longer-term bonds. It worked for years. It hasn't worked. It's not working. I think it's going to continue to have issues, and I think it's more important when it comes to retirement savings, and particularly when you're in retirement management. I think you've got to spread things across multiple asset classes. I think you're going to have to be more conservative because when this market goes down, I think it's going to go down very quickly. We saw it in February where it really in that March actually time frame where it just plunged very quickly and it came back and recovered. But the next time it does that, it's not likely to recover like that. It basically from the mid-February to March went down about 19%, and it's had a massive rally, one of the biggest ever since then, back up. But it shows you, particularly when Trump put those tariffs on, it fell 10 to 15%, almost within 3 or 4 days, actually 2 or 3 days, and that is a massive drop. It was very quickly, and so people did not have time to react. And I think that's going to continue to hold true in these markets here. So in that type of environment, you want to spread your risk around and manage it in a much more conservative fashion. And I think this is something for retirement that's going to be very important. But speaking of retirement, I saw a thing on healthcare costs. Fidelity did. A person that's 65 years old today can expect to spend $172,500 on health care. Now, this assumes they're in Medicare, and so this is the total cost. This is just what you're going to have to pay, and that also includes vision, dental, those type of things, Medicare A and B. That's kind of the number that you're looking at, and a couple thoughts on that is it shows you need the importance of saving money for retirement so you can afford that health care. But it also shows you, and we're big believers in this, the importance of taking care of your health. Because if you can take care of, if you're healthier, that cost is going to be lower. And so by looking at what you eat, managing what you eat, eating healthy, by exercising, those things improve your health, they improve your outlook on life, and they reduce your medical costs, which is I mean, this is more of a sure thing when it comes, investing. You're not sure if a stock's going to go up or down. We think they're going to go up. We're pretty good at it, but with healthcare costs, if you exercise, if you eat better, you're going to be healthier, and your healthcare costs are going to go down. All things being equal, and so that exercising, going to the gym. I was talking to one of our clients about the importance of, they're up there in age, and so it's harder for them to get out. We were talking, you can still go in, because some of our clients are telling, they actually exercise remotely, using some weights in remote, getting exercise groups remotely, for elderly people, those type of things. Walking around the block a couple times. The research is showing just walking around the block, walking a half a mile a day or so, 3 or 4 times a week, vastly improves your health. That's a pretty simple one. Now, I know in August it's not that simple in Houston, Texas, but these are the important things that make a difference. $172,000 is a lot of money, and that's the average. So if you can get under the average, you're spending less. Over, you're not. And so when it comes to retirement, one of the key things is managing your health, because that's going to reduce your cost. So something to do with retirement there. It's to manage the health, eat well. You're seeing one of the more interesting things we're seeing with RFK Jr. in place is so many of these companies are just scrambling to reduce the ingredients, which usually are chemicals, the preservatives, the dyes in their products. And I think we've all seen a little picture of the potato chips or whatever from 25 years ago, the list of ingredients, and then the list of ingredients today, they've got like materially longer. Like, look, all I want is potato chip, oils, and some salt in it. But that pendulum is swinging the other way. So healthy eating, that's a big thing now, and most of the corporations are all scrambling really because that's what people want. I mean, it's really amazing that this was a big Democratic issue, eating healthy, organic, and everything, and they somehow lost the whole issue. That RFK Jr., get away from him, and here he is sitting at Health Secretary and making big changes out there. And I think, again, health at $172,000 over your lifetime, if you can save money there, that you can spend money elsewhere. So the question comes in, Ted, this week we had the Fed meeting. It didn't go so well. There was dissension. Donald Trump was upset. We had a jobs number came in at 73,000. They're expecting 147,000 jobs. And then we lost 258,000 jobs in May and June, shocking the market. And then we have, Trump has added additional tariffs onto some countries. And by the way, as we talked about the trade talks, the toughest have really been with the Canadians. That's going to continue to be a problem. And then fourth, Trump is going after the drug prices. Now, he wants to force the drug companies to cut costs, to reduce costs from the American people. These are all not real big positives in the markets. Markets reacted pretty quickly. The S&P 500 was down substantially. It was down. In the 2 days, it was down 2.4%. Big drop. That's off a top. And one thing to keep in mind, if you look at the S&P 500, it had a kind of it opened at new highs and reversed and went lower. That's not a positive sign. Then the next day gapped down again from a new high, and that doesn't happen very often. And on heavy volume, it reversed on heavy volume on Thursday. And so the market is looking at all these things as well, and they're going, look, things aren't that good. And we've had a huge run off of the April bottom. So I think really, what we're looking at is I think you do have to be cautious here. We have to sort of see what's going to happen. And one thing that did come out today, if the U.S. economy slows, rates, if the Fed is going to cut rates, then the long rates are going to go down. It looks like across the board they went down. The dollar's going to fall. Gold's going to go up. And so it's going to be, again, this is just a lot of cross currents for a very expensive market. And actually, the fifth thing really was the move in Sigma, which was again, it came out at $40. I think $38 or $40. It ended up. It went as high as $140 in 2 days, ending at $122. That's incredibly expensive for the huge move in the stock. I mean, typically when there was massive demand, so they moved up the pricing on it, and even then they moved the pricing on it, and it still tripled or quadrupled at one point, came close to quadrupling in 2 days. And again, that just shows you the amount of speculation in the market. So I think you want to exercise caution. Again, when it comes to retirement, you want to manage your funds long term. You want to catch these big moves up, but at the same time, you don't want to give it all back when declines happen, because declines happen. They're going to move much quicker on the downside, as we saw back in March, April. I mean, they happen very quickly, and here we've gone up. It's taken us, from May, June, July, August to recover that drop. And this is the interesting thing. The recovery of 4 months was the quickest on record, from a 15% drop from when the tariffs were. That's the quickest on record. So things move quickly. And so take a look at your portfolios and protect it. Again, conservative investing, that's going to be the strategy going forward. And if you need some help, you can give us a call at Max Out Savings Advisors. Just go to our website, maxoutsavings.com, or you can also sign up for our free newsletter. We're working on that this weekend. We're going to have kind of our outlook. We write about savings, retirement, about all these things, healthcare costs. It's all in the free Max Out Savings Report to help people retiring, getting close to retire, dealing with retirement, dealing with wealth, dealing with managing your retirement assets through these very uncertain times. So if you need some help, just go to our website, maxoutsavings.com. It's maxoutsavings.com. Well, I appreciate everyone listening to the Max Out Savings Show. If you need some help, we'd like to help you. Just go to maxoutsavings.com. And remember our motto and philosophy, which is to save aggressively, invest conservatively. Save aggressively, invest conservatively. That, my friends, is the key to building up wealth over the long term. I hope everyone has a great weekend. We'll see you next week right here on the Max Out Savings Show.
This has been the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.